This is the masterclass for what, over the last 8 years of trading, I've found to be the best trading indicator of all time. A tool that's won me hundreds of trades, the Relative Strength Index, otherwise known as the RSI. Today, I'm going to reveal all of my trading secrets using this tool that I've documented over tens of thousands of hours. And by the end of this video, you'll have the ultimate edge in the markets. Believe me, you've stumbled onto a gem here. This video will be broken down into 3 sections. Number 1, overextensions. Number 2, resets. And finally, number 3, the killer reversal tool most traders don't know how to use, divergences. Make sure to watch every section all the way through, as each piece builds on the last. When combined, these concepts will make you deadly effective in the markets. They've brought me countless wins, and the honest truth is, I couldn't trade without them. So the first thing you have to know is overextensions. Above the 70 level and below the 30 level counts as a technical overextension on the RSI. Now, these give us good clues about price's intention, but they can't be used as a standalone trigger. They can be the start of divergences, and when talking about divs, we're starting to get into the area where it's a bit more concrete and we can start actioning our trades. Most new traders think that once price hits the 70 level or above, or the 30 level and below, they've got a trade on their hands. For instance, 70 and above, they'll look to short, 30 and below, they'll look to long. But what they miss out on is that in strong trends, the RSI can stay overextended for prolonged periods of time. And so by using this as a standalone trigger, they get caught heavily offside in the market. That being said, above the sort of 90 level and below the 10 level provide at least short-term relief in price, and at the best, a more sustained reversal. Next, we're looking at resets, which are absolute trend joining beasts. Resets are when the RSI taps down to or up to the 50 level. Now, this mid-level sort of acts as support or resistance to price, the same way it would do on a chart. Typically, these resets are exactly what we want to see for resets of momentum. For instance, in a raging uptrend, what will happen is the RSI will shoot up with price, go into the overextended region above the 70 mark, and then come down to cool off by dipping down to the midpoint or 50 level. Now, I tend to use a zone between the 55 and the 45 level for a reset. And whilst this does constitute a reset, exact taps down to the 50 level or up to the 50 level are extremely powerful pieces of confluence. So in short, in raging uptrends, you'll see the 50 level consistently respected as support, and in brutal downtrends, you'll see that 50 level consistently respected as resistance. Now, although you can use these signals on the lower time frames, they are particularly useful on anything above the hour. So the 1 hour, 2 hour, 4 hour, 12 hour, daily, 3-day, weekly, and monthly charts. Now again, these should be rarely used as standalone triggers, more as confluence that you can weave into other price action patterns, such as support and resistance, supply and demand, EMAs, Fibonacci retracements, whatever it is. Now, by virtue of them acting as support and resistance, losses of these levels can also mean traveling to the other side. For instance, if the mid-level is lost from the upside, we're likely to travel down to the 30 area, and if the mid-level is reclaimed from the downside, likely to travel up to the 70 area. Okay, so well done for making it this far. I've saved the best till last. Absolute reversal powerhouses, divergences. In simple terms, divergences are when price moves in the opposite direction of the RSI. Bullish divergences, otherwise known as bull divs, are when price makes a lower low, whilst the RSI makes a higher low. Bearish divergences, otherwise known as bear divs, are when price makes a higher high, whilst the RSI makes a lower high. After this occurs, you're looking to execute the div by waiting for the confirmation candle, which is the first candle that forms in the opposing color to the previous candles. Now, despite how powerful divergences are, you still need to take them in areas of left side price action, meaning support and resistance, supply and demand, etc. I'll put links to these concept videos in the description so you can check them out after. Now, divergences are easily one of the most powerful price action tools a trader can use. That being said, they do have their nuances and complications that you have to understand to nail them properly. So I've put together 7 golden rules that you can adhere to make sure you're tackling them properly. Number 1, draw from the bodies, not the wicks. If you have issues doing this, flicking over to a line chart can help. Number 2, remember we spoke about resets? Well, if the divergence strays into the reset or mid area around the 45 to 55 zone, then it's been technically invalidated, so don't use it and wait for the next divergence, which is forming more in the overextended regions. Number 3, you need confluence from the awesome oscillator, otherwise known as the AO. When the AO aligns with the RSI, it's what's known as a double divergence, aka you have agreement between both the oscillators. This acts as a sort of second layer of confirmation and will give your trades much higher probability. Number 4, make sure both peaks of the divergence are in the overextended region. So for bearish divergences above the 70 and bullish divergences below the 30. This will massively help sift out weaker divergences and again, increase your probability when using these concepts. Number 5, make sure it's not too wide or too tight. Between 7 to 15 bars is the sweet spot. That being said, don't be too rigid with this rule. If you're a bit under or a bit over, but still tick the other boxes, then you're still good to go. Number 6, flat divergences, otherwise known as flat divs. This is where price makes a clear directional push, whilst the RSI forms a divergence with equal peaks. These shouldn't be discounted as they are still valid divergences. Lastly, number 7, structure. This is basically about the visual shape of the divergence. You want it to be as clean an arc as possible. Now that you've mastered the RSI, it's time to keep leveling up your trading. I've put together the ultimate video for you, summarizing my 8 years of experience into just 4 minutes. If you've got that to spare, time to tuck in. So click here, your P&L will thank you later.